A massive deal just went down in the U.S. banking world, and you are going to want to hear about this. Fifth Third Bancorp just acquired Comerica, and trust me, this isn't just a small ripple. It's a wave that's completely changing the competitive landscape.
And the scale of this thing is just huge. I mean, look at this number. We are talking about a $12.7 billion all-stock deal. That's the kind of number that makes everyone in the industry sit up and pay attention.
So what does a deal this big create? Well, it creates the ninth largest U.S.-based bank. In one move, Fifth Third has gone from being a major regional player to a true super-regional powerhouse with a presence that stretches from coast to coast. A new heavyweight has officially entered the ring.
Now, whenever a merger this big happens, you know what everyone is waiting for, right? It's that first report card, the first quarterly earnings report. And what we got? Oh boy, it was a fascinating tale of two completely different stories. Okay, so if you just glanced at the headlines, what Wall Street saw looked kind of messy. I mean, earnings per share of just 15 cents, expenses shooting up by 83%, yikes. But, and this is a big but, underneath all that surface noise, a totally different picture was emerging. When you adjust for all the one-time merger stuff, you see strong earnings of 83 cents per share and a huge 34% jump in net interest income. The core of the bank was actually humming.
This leads to the obvious question, right? How in the world can the official numbers and the underlying performance be so incredibly far apart? What's really going on here? And here it is, the answer. Those messy reported numbers were all thanks to a massive, but, and this is the key word, temporary, $567 million hit from one-time merger costs. This is exactly the kind of noise you have to filter out to see the real signal of a company's health. So let's do exactly that. Let's filter out the noise. We're going to peek behind those messy headline figures and decode the key metrics that show us the true financial health of this newly formed banking giant.
First up is something called net interest margin, or NIM for short. This is like a core measure of how profitable a bank really is. A great way to think about it is like a grocery store's markup. It's the spread between what the bank earns on loans and what it has to pay out on deposits. A bigger margin means a more profitable bank. And check this out, because this chart brilliantly illustrates the bank's underlying strength. Despite all the merger chaos, the net interest margin didn't just hold steady, it expanded significantly, climbing all the way from 3.03% a year ago to a very healthy 3.30%. That is a powerful signal of core profitability.
Next up is the CET1 capital ratio, which builds on this picture of stability. This is basically a bank's ultimate safety net, its core financial cushion to absorb unexpected shocks. Honestly, the best way to think about it is as a household's emergency fund. It's the capital that keeps the bank solvent when things get tough. And get this, even after basically swallowing an entire other bank, Fifth Third's CET1 ratio landed at 9.96%. Sure, that's a dip from before the merger, but it is still comfortably above what the regulators require. This just shows they pulled off this massive deal without putting their financial stability at risk. And the final piece of this financial health puzzle is credit quality, which remains rock solid. The net charge-off ratio, which tracks bad loans, is at its lowest point in years. The ratio of non-performing assets has improved dramatically, and their rainy day fund for credit losses, it covers over 300% of those troubled assets. That is a very, very strong defensive position.
Okay, so the financials are solid under the hood. We've established that. But this deal wasn't just about getting bigger for the sake of it. Let's zoom out to the grand strategy, the long-term vision behind creating this absolute powerhouse. The strategy is actually pretty simple and has two main parts. First, geographic expansion. They are aggressively pushing into the fastest-growing markets in the country, especially in the Sun Belt and Texas. Second, they're scaling up their high-margin fee businesses. You know, things like wealth management and commercial payments that generate steady income without tying up a lot of capital. And here's what that strategy looks like in action. Just look at how diversified their fee income is now. Wealth management and commercial payments each make up nearly a quarter of the entire pie, creating a much more balanced and resilient revenue engine that's way less dependent on just traditional lending. And it's not just diversified, it's growing like crazy. Wealth management revenue is up 35% year over year, commercial payments are up 42%, and capital markets fees soared by an incredible 49%. These numbers are the proof that the strategy is really delivering powerful results.
And, to top it all off, here's a quote directly from Fifth Third's CEO, Tim Spence. He said, "Our focus is unchanged: stability, profitability, and growth, in that order." That really reinforces the disciplined, step-by-step approach they're taking here. It's not growth at all costs. It's smart, sustainable growth, built on a stable foundation.
So the merger is done, the strategy is clear. The question now is, what's next? Let's look at the road ahead and the key milestones we should all be watching for as these two banks become one.
Management has made some very specific promises, and you can bet they'll be measured against them. They're targeting $850 million in annual cost savings. They're aiming for a highly efficient operation with a target efficiency ratio below 53%. And for investors, they're targeting a 19% return on tangible common equity. These are the big benchmarks.
And they are not wasting any time. The deal closed on February 1st, and they've already pulled forward the super complex task of merging all their computer systems to Labor Day of this year. That's an accelerated timeline, and it's all designed to capture those cost savings as quickly as possible, with the goal of realizing the full benefits by 2027. So this big move to gain scale, expand into high-growth markets, and diversify into all these fee-based businesses leaves us with one final question. As you watch this whole integration unfold, you really have to wonder, is this the blueprint for the future of American banking?